Live to Melbourne, Chris Conway from the Australian Stock Report to reflect on the week that was and events to come. Welcome into the show. Technically speaking, we ain't done a lot of the last 5 trading days from when we last spoke.
We've done very little, Carson. The market is just hanging up here on its lofty peaks around the 52-week highs. And everyone's really waiting for Janet Yellen tonight. I ultimately think they're going to be disappointed. I don't think she's going to say anything of much consequence, and we'll grind out the remainder of reporting season next week. Probably won't budge from levels that we are at now.
If this week was about anything for you, what was it? I mean, is it the volatility and that piece, the lack of it, that stands supreme as a factor to remark on, or something else that you have divined?
Look, I think there's a dichotomy going on in the Aussie market at the moment. It's one that we're all abundantly aware of, and that's the fact that, you know, growth proxies, bond proxy stocks and growth stocks are really propping the market up, and yield plays at the moment. And it's the top end of town, the Woolworths, the Wesfarmers, that are struggling for revenue growth, and margins are being contracted. So, you know, the top 20 is still struggling, as we all knew that they were. Nothing has changed from the results that we've seen over the course of the last 2 weeks. And there have been pockets of excitement where very exciting growth companies that have delivered exceptional results have marched higher. So it's really a two-speed market at the moment, if you will.
Is this the new normal, though, that the former Goliaths are now more David-esque than anything?
Look, it is for the moment, but as we all know with markets, the moment everyone thinks a theme is going to last forever is the moment essentially that it changes. So I think there will eventually be a rotation back to, you know, those top 20 stable companies that are considered perhaps safer. And it might be when, again, as everyone is talking about, when the Fed does finally normalise interest rates with some frequency rather than the maybe one per year that they've been speeding along with recently. When that situation does become more normal and rates go up relatively quickly, well, that's when some of those bond proxies and those growth stocks, you know, you would expect to come back to probably where they belong, and there'll be a rotation back into the big boys, the safe boys.
Well, you touched on Woolworths. Wesfarmers was also making news this week with its own set of numbers. You'd have to say, if anything, that they were a tad disappointing even on expectations. The call out was 2.29 bill. If you take out the write-downs from the result in the event, they came in at 2.25, so slight miss there. You've still got the old bugbears around their neck, the old albatrosses. So really, if you take a step back, who's hungrier and who's better positioned now that you've tick on the likes of Masters and a better strategy on loyalty for Woolworths?
Look, it's the million-dollar question in that space, Carson, a very, very interesting one. I think Wesfarmers is in a stronger position, no doubt. They don't have quite a long shopping list of blunders, pardon the pun. But Woolworths is the story that everyone's focused on, and it's become a hope stock. You know, now that they, as you say, have the albatross of Masters removed, you know, potentially if this new CEO can get things right and they can protect their margins, which contracted very sharply over the last 12 months, but if they can maintain some solid margins, now that they'll get a bit of money back from selling off Masters and the hardware and whatnot, you know, they can focus on their core operations. So that story potentially has more in it, but like everything, it's only if you're prepared to take on the risk. Wesfarmers, if you just want to put something in the bottom drawer and not really have to worry about it, as I said, comes from the stronger position. But everywhere in that space, it's got challenges. We all know the story about Aldi. We all know about margin compression. Now we know about Home Timber and Hardware teaming up with Mitre 10. So that creates, you know, a competitor to Bunnings, which has been a major growth engine for Wesfarmers. So competition is just so fierce in that space. I struggle to see where significant growth is going to come from.
All right, Flight Centre this week, shares hit a more than 3-month high. They went up at 4.1%, and they finished the week out in buoyant territory, a 3% rise. Deutsche has raised the price target, keeps a hold though, and so too the brokerage Bell Potter. So reflect on it on a yearly basis, down 9%. Really, are you confident from what you've seen this week that there's the potential for a new leg higher?
I'm certainly more confident than when you and I were talking about this stock last week, Carson. I know you talked to a lot of people throughout the week, so you probably don't remember. But you put it to me that with Webjet reporting exceptionally well and having that 20% jump on the day, that the shorters might come out and attack Flight Centre again. And I agreed with you. Don't we both now have a bit of egg on our face? I did say yesterday that their numbers were solid, revenue up around 11%. I think they look relatively cheap as well. I think they've got a cash-adjusted PE of around 11, and it's a solid business. You know, they continue to generate good cash, and they can use that cash to compete against the likes of Webjet and CTD and others operating in the space. So, you know, it's jumped 7% in the last two sessions. I think it's probably more of a buy down around towards 30 to 32, but it might not revisit that price point for us for a while yet.
So how much of that would be short squeeze to our, you know, ruminating last week and now somewhat of the reality? A number of those shorts flushed out on these numbers.
Yeah, look, some of it no doubt will be a short squeeze, but there was another stock, the company escapes me, but people were talking about short squeeze. It might have even been Woolworths. In fact, it was Woolworths. And people talking about, you know, the results being not as bad and a short squeeze and a big pop on the day. But both of these stocks have actually rallied fairly strongly off their 12-month lows, their recent 12-month lows. So one questions how many short positions there were still in the system. Some of it's got to be new, fresh, naked buying. It has to be. So some of it would be definitely short covering, but I don't think all of it.
Cabcharge, we talk about models that are under the spotlight, the business ops and the next chapter. You know, Reg would hardly be doing somersaults, would he, if he was leading this release, as it is probably proverbially turning in the grave, or do you beg to differ?
Look, I'm generally pretty negative on Cabcharge. I watched with interest. It was actually a shame. I had to leave for the studio at about 20 to 4 when Andrew Skelton, the CEO, was being interviewed by James, and he actually talked really well about the opportunity now that is being presented to Cabcharge, now that they can view themselves in a different light. The worry that I have is that the horse has already bolted. It's like the old MySpace, Facebook. You know, MySpace had the great idea and was first to market, but they didn't execute right. Now, Cabcharge probably won't be allowed to execute right because they've got the legacy of not being an Uber. So you've got Uber coming into the space, competing so hard, competing on payments, competing on matching customers to services. And that's only going to grow. So, you know, I like the enthusiasm of Andrew Skelton, the CEO. I just think it might be perhaps a little bit misplaced. And the other thing that was a worry for me in the numbers, aside from the drop in profit, is the number of payments, and the revenue from payments declined. That is the core of their business. Clearly enough, there's not as many people using cabs, and that speaks exactly to that Uber story that I was just talking about. So you balance the enthusiasm from the CEO and the positive way that he's looking at the company and he's talking about bringing the drivers along with him and revolutionising. How far behind the 8 ball are they? That's the question that I ask, and I think probably a pretty long way.
We always kind of look upon the idea of synergies as all well and good in theory, but when you kind of look at the acquisitions in the cold light of day and whether they are or they aren't meeting expectations, sometimes there is a dislocate between what was promised and what is playing out. Let's look RCG. Here we have Hype, one acquisition, not exactly firing on all 4 cylinders. So what do you think the future holds, given the other suite of offerings, the likes of Dr. Martens and Skechers, that they tell us will be good performers?
Look, Carson, I can give you a little bit of anecdotal information about Hype DC, because I used to work for the company in another lifetime, probably about 15 years ago.
Disclaimer. Right.
The disclaimer, absolutely. Yeah. But I'm familiar with all those brands. I'm familiar with the company's margins firsthand. Their margins are very strong. Hype DC was purchased for $105 million. In Q1 2016, they had exceptional sales growth because they had an exclusive line of products that customers, you know, couldn't get enough of, quite literally. I think it was, like I said, 50% growth. In the early stages of the takeover by RCG, they've recorded a 7% decline in growth. So, you know, here's a company that's just spent $105 million on Hype DC in the stores that they have, and all of a sudden there's a 7% decline in sales growth. It's not a wonder that the stock got sold off quite aggressively yesterday. But like I said, peeling that back, I know the company pretty well, although I'm sure things have changed quite considerably in the last decade and a half. But I know the brands, like I said, I know the margins. They were always exceptional. I think that will be a great acquisition for RCG once they incorporate it and once that business starts hitting its straps. I think it will work well. They want to open 8 new stores this year, and they want to close 2 stores that are underperforming. So I think they will do well.
And what about the dollar play on this as well? Just the import story to drive this, because these are products primarily from North America.
Yeah, North America, or in the case of Dr. Martens, I think the UK. So yeah, look, I mean, currency changes are always going to have an impact, but they will across any business, especially a net importer, as RCG is. They'll have to manage that as best that they can. Of course, like I say, will have an impact, but remains to be seen. I'm no currency forecaster, unfortunately.
You and me both. We look to next week briefly. What's on your top of your list?
I think Ramsay Healthcare is the only one that is of any interest to me next week, and it's not a stock that I cover in great detail, but obviously because of its position and size in the market. But other than that, no, look, Carson, to be perfectly honest with you, after the last 2 weeks, I'm looking forward to next week being a fairly quiet week.
Indeed, and we got some extraordinary images. I'm not sure I'm putting the producer under the pump here, but Domino's this week came out and said to us, look, we are leaders in class, and we will get the drones to deliver. Even if even if there are other issues around the roads and all the rest of it, we can take to the skies. We can do this one. They've done it in NZ as in a test capacity. What do you make of this? This is innovation, and some.
Look, it certainly is, but that's what Domino's business model is based on. It's not based on the fact necessarily that they make great pizza. It's that they've been able to integrate technology into their business and take full advantage of it. What do I think of it? Not much. I think people who are ordering pizza probably should get up off the couch and at least drive down to the store and get it. Will it be something that people take up en masse? Well, probably they will, and it will probably provide another leg up for the Domino share price, which is already quite lofty. So, no, look, I do like the use of technology. I like the fact that they're integrating technology. I like the fact that they're looking for always new and innovative opportunities. That's a sign of an entrepreneurial company and entrepreneurial leadership, but I don't know whether I'd use it.
Yeah, there was no heat bag to keep that thing hot and piping hot as well. They smiled and they chowed down, but yeah, was it cold? Probably, like the weather where the drone landed. Thank you so much as always, Chris.
You're welcome, and thank you.
Australian Stock Reports, Chris Conway there for you in our Melbourne